Well, welcome everybody to the June session of our roundtable. It's co-sponsored by the Mid-Michigan chapter of Better Investing and Manifest Investing. And we really enjoy being with you. We've got some interesting stuff to cover here tonight. My name is Mark Robertson. I am managing partner and founder of Manifest Investing. I hope to be joined here shortly by Ken Kabula when he shuffles microphones or computers and comes back into the room.
And you are joined, Mark, if you can hear me. Can you hear me?
We have been joined.
Great, great.
We were scheduled to be joined by our friends Cy Lynch and Hugh McManus, but Hugh got delayed on travel, something that I believe almost everybody here in the room can relate to. And Cy Lynch is responding to a family situation. His wife was involved in a traffic fender bender this afternoon. But again, welcome to this month's session. We have captured the spirit and energy of Jurassic World. I haven't seen it yet. Any feedback on Jurassic World, Ken?
Well, my son went and saw it, and he didn't like it at all, so I don't know. But that's one of the few people that I've heard that didn't care for it very much. My granddaughter thought it was absolutely wonderful. So.
Well, I find it interesting because that franchise goes back 20, 25 years, and one of the reasons I chose it for kind of a theme for us to dwell on perhaps for a few minutes is just the excellence of the franchise. They basically have gone over $1 billion in box office receipts already. And it just reminded me of a couple of things I thought we would just talk about for a minute before we kick the doors open or get the program underway. And it's basically this notion of it is okay to go back to something that's worked, 10 years ago, 20 years ago, 30 years ago. And a lot of times those things can really be quite rewarding. And I'm speaking of specific investing opportunities. We might get a chance to take a look at Southwest Airlines. That's been fairly rewarding to a number of people over the years. And there are just a number of examples of that. And the second thing that comes to mind when it comes to this, it goes back to my days when I was senior contributing editor for Better Investing magazine. And every time we would receive letters in the mail, Ken Janke and Tom O'Hara and Don Danko would consider it to be a perfect indicator of market tops because we would get these letters in the mail, and I'm not paraphrasing a bit, would say, you guys are just a bunch of dinosaurs. Your analysis methods are straight out of the Jurassic period, and you guys are all just completely missing the world of investing. And every time those letters would start to land, it was time to be more careful. And I'm not so sure we're not pretty close to one of those right now. I recently got a note kind of along those lines. And again, every time we get that type of correspondence, it just kind of, the hairs on the back of my neck stand up a little bit, and I get just a tiny bit more cautious. We'll cover that in the program here tonight also. Any thoughts on that subject, Ken?
Well, Mark, I'm in a long-time investment club. My Wolves Club is coming up on its 25th anniversary. And by the way, Herb Lemkool up in Traverse City, congratulations on the 25th anniversary of your Cherry Capital Investment Club. I see that that's coming up this month. But my longtime investment club, the Wolves, we've been around for almost 25 years. And in February 2007, we had 3 members just up and resign. That's a very odd thing for my club. It's been very stable and had maintained membership in the 15 to 17 range for a long, long time. These 3 members just up and resigned one day because their broker convinced them that all of our methods were losing them money. That wasn't going to keep them even with everything that was happening. And if I can draw you back to what happened later in the year in 2007, that ties in real quickly with exactly what you were just saying, that when you get that kind of feedback, maybe it's time to worry about what the market's going to be doing pretty soon.
Yeah, and perhaps we'll get a chance to talk about that a little bit more at the end. With just the two of us, we'll present our 2 stocks, and there probably will be ample time for more conversations. But yeah, anytime I see those type of things surfacing, it could be time to be more careful. Let's go ahead and get some of the other stuff out of the way. Again, welcome to everybody. Welcome back if you're returning. a big welcome hug if you're here for the first time. We do keep this fairly informal. The whole intent is to share ideas, actionable ideas for you to study and consider how it might fit in your investment world. And Ken and I will be spending some time on a couple of specific stocks here tonight, but this is kind of our standing agenda. We'll take a look at how the portfolio is done. We're now coming up on 5 years. We actually started in July 2010 doing this on a monthly basis. We'll take a look at how some of the selections that we've made over the 5 years have done, including BioReference Labs, ticker symbol BRLI. And then we'll go into presentations. I'm going to go with Baidu tonight, the Chinese Google, and Ken is going to go with Polaris. Hugh probably was still having trouble finding a stock, and Cy couldn't decide, but if we forced him to make a decision, he probably would have gone with Priceline. That's just FYI. Again, some of the legal housekeeping. Everything that we do here is for educational demonstration. It's for illustrative purposes only. It's about demonstrating a philosophy and a process that's been successful for decades for a relatively large community of investors. Everything we do here, however, no investment recommendation is intended, and you must do your own homework. If you do have any questions or follow-up that you'd like to do on the session itself, you can reach me at markr@manifestinvesting.com at the bottom. And if you'd like to be added to a reminder list, or if you have a friend that you would like to have added, send a note to Natalie. That's ncavula1@comcast.net. Let's just visit again. We use this slide every month. It's just a reminder that we are sharing, one of our single, best or most compelling investment opportunities right now. We do tolerate non-core positions, and Hugh certainly had one of those last month. And the whole intent is to build a collection of stocks. We keep track of the performance of every single decision made. And we'd like to see that collective set of decisions outperform the Wilshire 5000. We use that as the total stock market benchmark by 5 percentage points over the long term. In order to do that over the long term, we're going to have to achieve probably 12 to 15% annualized return. And then we'd also like to see about 3 out of every 5, perhaps even dream a little bit, 4 out of every 5 selections that we make actually outperform a mirroring or matching benchmark since the time of selection. And we keep track of that again on an individual basis. Going to the next slide. This takes a look at how we have done in terms of relative return. On Wall Street, they refer to it as alpha. It's basically whether you're outperforming the market or not with your investments. Every single investment that we make, and then we also do it collectively, we take the performance, the actual performance, and basically subtract or compare it to the Wilshire 5000. So we'd like to see us reach that red dotted line up there. The trend, you can see month to month for the last almost 5 years now, is certainly riding the right wave. And thanks to some of the pretty good moves here in just the last month, it's rolling along pretty good. We're in there into about that 2.5% range. We'd love to see 5. We'd love to see between 5 and 10%. Just FYI, I think McManus is up to 8% individually, thanks to some of the stuff he's done lately. Good, clean fun. On that outperformance accuracy, again, about half of the selections have outperformed the market, and that's actually up from what it was fairly recently. So again, I think the takeaway is we seem to be headed towards the red line, and all the trends seem to be in the right direction. Kind of a slow start for us. Whose fault was that, Ken?
We don't point fingers, Mark, okay?
I can probably name a couple specific positions back in that first and second year that was not helpful. Well, here's a look at the portfolio. Ken, would you like to walk us through the portfolio and the report card here in the next couple of slides?
Absolutely. We have a question from Joe, Mark, that we might want to take sometime during the evening. Joe would like to have us suggest some metrics that would emphasize the creation of a more conservative portfolio. So on our way to finishing this presentation, I'll try to remember that question and try to point some things out. Joe, my immediate reaction would be that you probably would be creating a more conservative portfolio if you were looking at high quality stocks, and if you were looking at those high quality stocks that were growing perhaps at a rate of 10% or less. In other words, putting yourself into high quality large companies, I think is certainly a fairly conservative position. What do you think, Mark?
That's exactly what I would say. It really does come down to quality. In fact, when I get to my portion of the program, I'm going to point out a screen where uh, I'm concerned that the market is, I have no idea when the next recession or correction is going to happen, but I am concerned that it's kind of vulnerable right now. And when it gets vulnerable, I don't say run for the hills, but I do say protect yourselves. And one of the ways that we do that is to ratchet up the minimum quality requirements, ratchet up. Si's a great fan of ratcheting up the minimum financial strength during your shopping. In fact, during times like this, he's probably out there shopping for companies with financial strength ratings of A and above. So he just tightens everything down and is more careful. Something else we might come back to, don't want to get too far off, but we have had an inquiry to put together uh, a portfolio, kind of a model portfolio for more senior, more experienced people that and maybe perhaps in terms of years, 65 years and older, that type of thing. And I think you'll see us take a stab at that in the forum and in some of the articles that we write. And it's right along the lines of protecting yourself, preserving capital while still investing in stocks.
Mark asked me to kind of walk through what you're looking at on the screen right now. At the very top of the screen, boxed in with a yellowish background to it, is the URL for this particular dashboard. Anybody can get this dashboard on their computer. You don't have to be a Manifest Investing subscriber. So take a look at this dashboard if you want, and it's much longer than can fit on the screen here, but it includes every single pick that we've made in this roundtable program going back almost 5 years right now. The logo at the very top there can tell you how many different times we've made some of these picks. So, for example, our most picked stock has been Cognizant. It's been picked 12 times, probably 10 of the 12 from Cy Lynch, right, Mark?
I think that's right. Yes.
All right.
He threatened to pick it again.
Qualcomm being picked 9 times, Staples 7 times, Apple 6 times, Caterpillar 6 times also, and then a whole slew of 5-time picks, 4-time picks, a lot of them there, and a lot of 2-time picks. And then if the company's not in this particular logo, it's only been picked once in the roundtable. You can also see if Cognizant's been picked 12 times, that means we've put $12,000 into the stock, and today it's worth $19,700. So that's a pretty decent return, no matter if it's 5 years or 4 years or 2 years. That's a fairly decent return. You can see the value of all these, and obviously the stocks that have been picked fewer times that appear at the top of the list here are some of the best performers. PRAA, for example's only been picked 3 times. You can see it there about halfway down the list. It's only been picked 3 times. That means there's $3,000 sitting in the stock, but it's worth over $6,000 today. So we have more than a double in our since it was chosen on the various times. A universal display OLED has also only been picked 3 times. That's about 3 beneath PRAA, and it's also worth more than $6,000 today. So you could take the entire dashboard. I'll give you a clue. If you highlight the whole dashboard, once you open it up, you can actually then copy it right to an Excel spreadsheet, and you can play games with this thing to your heart's content. You can sort and add columns and do anything you might want to play with it, and frankly come up with some fairly decent ideas on what's been performing really well since we began this exercise, and some of our mistakes as well are appearing on the other end of the chart. Mark, are we looking at the scorecard on the next slide?
Yep, we are.
This is the scorecard for the entire portfolio. On the right, you have a nice pie chart showing our sector diversification. And like many of the portfolios in better investing circles, we're a little bit heavy right now on technology stocks. That's where a lot of the opportunities have been in the last 3 or 4 years. We have a nice holding in healthcare and industrials, a fairly nice holding in consumer discretionary, and then smaller holdings in some of the sectors where it's much more difficult to find good solid growth. You're going to have a hard time finding growth in utilities, materials, energy stocks. We might be a little bit light on financials. This might be the time as the Federal Reserve signals that it's going to start raising interest rates. This might be the time to take a good look at some financial stocks. I'll tell you right now that on some of the screens that I've been dealing with in the last couple of weeks, I've noticed a whole slew of asset managers rising to the top of my high quality, high par screens. That's companies like BlackRock and Waddell & Reed, companies like Franklin Investments and T. Rowe Price. You might want to take a look at that particular industry. Fairly easy, fairly straightforward industry to study. It's not as complicated as some of the big money center banks, but if you're looking for financial stocks, there's maybe some opportunity right there. Here's the portfolio averages on the left for our particular portfolio. The MyPar value tonight is 6.6%, and if you're new to our methodology at Manifest Investing, then you need to have that number explained real quickly. Imagine that Manifest Investing did a stock selection guide for every single stock in its database, and right now that might be as high as 2,400 stocks. If we were to do a stock selection guide for every single stock in the database and then collect the par values for each one of those stocks right from the SSG, and then average all those par values together for all 2,300 stocks, we'd get the MyPar number. And this number changes daily. Doesn't change too much, but it does change daily because the values, the potential annualized return for a stock changes as its price changes. Well, at the close of the market today, the average stock had a par value of about 6.6%. We're trying to aim at a spot that's 5 to 10 percentage points above par, and that's coming from Mr. George Nicholson, who founded the investment club movement probably more than 60 years ago right now. And he said that he thought you should be able to achieve a 15% return. If we move from the tools that Mr. Nicholson had back in the late 30s and early 40s, where he had to do everything either by hand or with the assistance of a slide rule, and move now to computers, we think that Mr. Nicholson's goal today would be try to beat the market by about 5 points, and let's not be greedy. Try to look for stocks that have this potential of 5 to 10 above the market. Well, when you add a range of 5 to 10 to the MyPar value, you get this 11.6 to 16.6 sweet spot. Notice that the par for our portfolio is just slightly under the low end of the sweet spot. It's not low enough for me to get panicked or anything, but I'd love to add some more stocks that would help us raise that par value back towards the sweet spot if we possibly could. Quality, absolutely wonderful at 84.5. Growth, a little bit on the light side. Mr. Nicholson, a number of different times, made the statement that he thought in order to beat the market by 5 points to achieve that 15% goal that he kept talking about, he thought that growth had to be somewhere in the 11 to 12% range. We're a little bit light on 10.3, and I'd like to add stocks that are growing a little bit more quickly as we move forward so that we can move that back up towards 11.5%. PE ratio a little bit rich right now, but you know, it's not too different from the average of the market as a whole. The entire market right now is carrying a PE ratio that's a little bit on the rich side. So I'm not too concerned about that PE ratio. I love yield, but our focus isn't on yield in this portfolio, it's on growth. So for this portfolio, yield is just gravy. Financial strength, Mark mentioned that Cy especially loves to keep the stocks that he chooses at a financial strength of A in the value line system. That translates to about an 80% in our system, so I'll take that 79 without any question. And earnings stability can be thought of as how straight is your earnings line, how consistent are those earnings? Do you have a nice year over year over year over year growth in earnings, or are they all over the place, growing double digits one year and then losing money the next? The higher the earnings stability number, the straighter that earnings line is on your stock selection guide. And my own personal goal is around 80%. I don't think there's anything wrong with that 75, especially because we entertain the idea that there can be non-traditional stocks in this portfolio. Mr. Nicholson, again, in his wisdom, said that 15 to 20% of your portfolio could be invested in non-traditional investments. And that might include initial public offerings even. It might include young stocks or stocks with no earnings. It might even include cash. It might include things that you would not normally consider core holdings. He emphasized that you want 80 to 85% of your holdings in these great up, straight, and parallel stocks where you're getting consistent growth in earnings and consistent growth in sales. But I don't think that the 75 is that bad. I'd like to see a little bit more focus on stability of earnings. But I don't think I'm going to convince Hugh to stop picking stocks that don't have blue lines. So with that being said, Mark, I'll turn it back to you, and we'll see if you have anything else to add.
Well, I certainly concur. The sector diversification is pretty good. The PAR's a little light, and I'm with Ken. I'd like to see 11% overall, but that's no big deal. But yeah, overall looks pretty good. What I thought we might do is
Mark, we are getting a question. That 10.9 par value, that does, Roy wants to know, does that include the yield? And it does, in fact, include the yield. The par does. We adjust all of the prices for dividends, and that's included in the potential annualized return when it's calculated.
Yeah, for those of you that are familiar with the Better Investing Stock Selection Guide, the yield, the projected yield, is included in the Section 5 calculation, and what we do is absolutely no different. All right, pressing on.
Yep, I've covered the questions for the moment.
Well, I took a look at the portfolio. There really aren't any stocks that are really on the hot seat, so to speak. Probably the closest thing we have is Coca-Cola at 4%. And I'm not ready to talk about selling Coca-Cola at a projected return of 4%. Everything else actually looks pretty good. So there's not any tremendously weak component down at the bottom on the hot seat. There is a kind of a special situation that that many of you are very familiar with, has to do with BioReference Labs. Interestingly enough, BioReference Labs, ticker symbol is BRLI, was selected by Psi at our very first session back in July 2010. And it's actually performed pretty good, 14% annualized return since then. But it's been selected on 4 subsequent occasions, 2 more times by Psi, 1 by me, and the audience seconded mine back in October 2011. This gives you kind of a look on the inside of some of the accounting that we do on a transaction or a decision by decision basis. You can see the average cost of all those entry points versus the price as of this afternoon. And we basically measure that total, and those are your annualized numbers, annualized total return versus the market return annualized. And the total return minus the market return gives us this relative return, or alpha, on the right-hand side. So you can see that 4 out of the 5 decisions that were made, and there's nothing wrong with that first one either. You're always going to have some of those in the world of investing. 4 out of 5 have actually beaten the market during the holding period since those purchase dates that you can see on the screen. This company, it was announced just a few days ago, in fact, shared by our subscribers. Nick Strategos, one of our guest knights, and John Kimmel from Kansas were the first to basically have it come across the transom. This company is being offered a buyout by a company by the name of OPCO, OPKO, ticker symbol OPK. And it's a kind of a different, innovative firm. And the offer is 2.75 shares of OPCO for every share of BioReference Labs. Now, as of today, that'd be about a $42 offer on the buyout. On the right-hand side, you can see that led to a jump from $32 to, at one point, I believe, nearly $47. I think it got up as high as what's on there, $46.74. Some of you in the audience actually exited at that point. And Cy, especially since he was the first one to bring it to the table, this has been a community favorite. It's in the top 10 of the Manifest 40, so many of you hold it in portfolios, or you certainly have been watching it very closely over the years. We regard it as, well, certainly up straight and parallel, and a pretty cool company, even if it's misunderstood and perhaps a little bit despised on Wall Street. And our forum folders are just rich. The boards are rich with commentary, some of the short selling attacks on the company. But Cy's basically suggesting that we should at least scratch our heads as to whether or not we should close out our position, take the money, and run. And with that, Ken, what are your thoughts on the subject?
Well, I'll tell you, Mark, there's 2 scenarios. Scenario number 1 is that the offer goes through, and once the offer is accepted and comes closer to fruition, I think that the price on BioReference will adjust itself pretty closely to the price on the 2, and is it 2 3/4 shares they're offering, something like that?
Yeah, something
2.5 shares, yeah. They'll adjust themselves so that they'll be within pennies of each other. Right now, they're about $2 apart. So I can wait for that all to happen, and I can make an extra $2 on my stock. Or the other option will be that the deal falls apart. And in my thoughts, if the deal falls apart, BioReference will move back down to around the average of where it was trading prior to all this talk, and that's in my mind, in the $30, $31 range. In that case, if the deal falls apart and I sell tonight, and I still like BioReference Labs as an independent company, then I can come back in and buy it, and I've made $8 or $9 a share on the stock at that particular point. I'm not going to be greedy. I've always operated on the premise that you don't have to be greedy in order to make nice money in the stock market. And in fact, I'd rather have the dollars in my pocket than to speculate on making an extra $1.50 or $2. I never could understand people that wanted to buy a stock and put in an order for $1 under where it's trading, and then watched it move and leave the price that it was trading at and never look back and never been able to make the buy.
Oh yeah,
So I'm
I've done that.
thinking, yeah, I'm thinking that I concur with Cy that it's time to say goodbye to these 5 positions. We'll lock in 4 positive positions and 1 slightly negative position. And when it's all said and done, if BioReference survives as an independent company down in the $30 range again, maybe Cy and I both will be some of the people to come back to the roundtable with some ideas about buying this stock. I actually do own this stock in 3 different portfolios. I've sold it out of one portfolio where I'm operating based on some rules that I use, but the other 2 portfolios right now I'm holding it. So I guess if I'm going to be true to myself and if I'm going to be able to look my wife in the eye, I better sell it in real time if I'm going to sell it out of this one as well, right, Mark?
Right. And I think what I would add to all of this and to help the audience perhaps put this in some perspective. One, I would love to hear Hugh's comments on this. I don't think he's chimed in yet, but if you go to the Manifest Investing website, this thread has been up there for all the information you could possibly need, shared by Nick and the whole gang there. You can see it's up to almost 1,000 hits. All the details are there along with some debate. But one of the things I wanted to show you tonight is basically OPCO is using their own stock as currency in this transaction. So they're trading OPCO shares for BioReference Lab shares. I think it's a kind of a hyperinflated currency. And the reason that I say that is as recently as 8 months ago, this stock was trading down around $8, and it has shot up. It almost got to 20. So you're talking a couple 100% sudden price appreciation. I think they're probably taking, again, nothing wrong with that. They're being opportunistic, but that doesn't give me a lot of confidence to the upside. If this thing were to relax back down and approach some of those long-term trends, the BioReference Labs price would certainly track it and follow it. So I think it's inflated to the top side, and I'm with Ken. If the deal does fall apart, no signs of that yet, but if it does fall apart, BioReference is probably going back down to 30. Now, the only counterbalancing argument here is OPCO is run by a pretty successful guy and somebody that Hugh probably has some familiarity with. Pretty innovative, a little bit different. That's certainly nothing new for BioReference Labs, but it could be worth checking in. But in our situation, I would vote to go along with Ken's suggestion, or actually Cy's suggestion, that we go ahead and take the money and run.
Yeah, Mark, we're getting a comment from Gene. Gene says that it sounds like neither one of us want to hold OPCO. And Gene, I'm not so sure that it's a decision about whether I want to hold OPCO or I don't want to hold OPCO, but OPCO is definitely a different kind of stock than BioReference Labs. BioReference, if you look at the stock selection guide on it, it's up, straight, and parallel. It has good, consistent growth in revenues and earnings for a fairly long period of time. And you compare that to OPCO, this is OPCO's value line sheet that Mark is showing you right now. And I'm focusing on the earnings line, and all I see are D's in front of all the numbers. That means that they've never made money in the last 12 years. And it doesn't appear that the future holds money making for at least this fiscal year and next fiscal year. There is a 20-cent projection out to 2018, 2020, and I know Value Line does not include the potential of an acquisition when it's doing its analysis. So that means a 20-cent plus for just OPCO itself, but still it's a completely different kind of company than BioReference, and I'd have to evaluate it using some of the ideas that we have been learning from Hugh about whether or not there's enough in the pipeline, whether or not there's enough product the company has future potential or not. We're certainly not going to be able to evaluate this using a stock selection guide, though.
That might change a little bit when the two companies are blended together. BioReference is going to bring a whole lot of stability. And you know, it's an interesting blend. You can see right there the CEO has mentioned Philip Frost is the guy's name. Again, if you're on the fence, I would read up on Mr. Frost. They're pretty optimistic about him here. You know, and it could be that they've got a heck of a plan for bringing these two companies together. And you know, the stability of a BioReference Labs along with the emerging innovation of an OpCo into something that could be quite rewarding. But I guess I'm from Missouri on this one. I'd like to see the pro forma, give that some thought and that kind of stuff. But in the absence of that, for right now, I think we go ahead and exit it for the roundtable portfolio.
I concur, Mark.
All right, so let's go ahead and do that. We'll go ahead and close that out, and it's a good situation. The audience gets a pretty good locked-in position there at that 4.5% relative return. Again, that's not bad over the last. That's almost a 4-year run in that situation. All right, let's go ahead and I'll kick things off with my stock selection. I want to talk a little bit about something that Ken and I have been doing a number of investment club visits over the last several weeks. And first of all, we love doing them. We learn more than you do. We have so much fun doing them. And one of the things we covered in a club visit just last night was this notion of looking for catalyst checkpoints. And what it has to do with is, you know, perhaps beyond the traditional stock selection guide, is there something that we can be looking at to perhaps nudge us from time to time to update our studies, perhaps incorporate some different kinds of thinking, you know, second guess ourselves, audit, verify, all that stuff. And for the last several weeks, probably going on much of this year, we have included these 1-year analyst estimate target ranges and the returns based off of them in all of our analyses. What you're looking at here is just going out and finding the companies that have the biggest. Let me go ahead and get my pen back in service here. Companies that have the largest return expectation for the next year, according to the analyst consensus estimates. That's ACE. For the most part, that's coming from Finance Yahoo. In some cases, I use marketbeat.com. I'd encourage you to visit both of those sites. We've used Finance around here, Finance Yahoo, for quite some time. But all I'm looking for here is a couple things, and it comes a little bit clearer on the next slide. Combination of companies that have fairly decent quality rankings, and for this I limited things to 50 and above, so they're going to be average or better, and a decent long-term forecast. Our consensus projected annual return is right here, shown in the middle of the page, and in combination with you know, basically a street or a herd expectation that's elevated for the next year. And sometimes those might lead us to some fairly interesting places. We were talking before the session about a month ago on this list was Rockwell Medical. That's a dialysis company out of Wixom, Michigan, which just happens to have gone up about 100% in the last month or so. Hughes Selection last month actually ranked very high on this type of a list just a month ago with not quite as tight a quality filter, and he's up 47%. Could be an interesting area. Again, a nudge just that something interesting might be going on. Again, they can all be wrong. The analysts can all be wrong, and they can be very sudden in correcting their work. So these are all things to be aware of. What I find kind of intriguing about this one is, wow, 3 coal companies up at the very top. Coal has certainly been hammered. It probably is an area of opportunity. My thinking on this one as to why I would probably avoid it at this time is it's public enemy number 1. And I would probably throw this almost into the same type of class as Strayer Education and Educational Services 4 years ago. You know, the deck is stacked against these companies is as incredibly important as coal is going to continue to be for some time to come. And I'm also a fan in reducing it over the long term. it's still going to be quite a persistent contributor to our nation's energy needs, and even more so internationally. So, there could be an interesting opportunity here. The firms that follow the companies see the potential for quite a price jump. I'm not sure I'm on board with them. The next couple of companies, similar stories, bolder brands. I'm really not seeing anything terribly interesting here. Taxi Medallion Financial is probably an interesting study. Credit services company, the fascinating ticker symbol. One of Ken's asset management companies is bubbled to the top of this list, this Geo Group. He didn't mention that one. It could be an interesting study. But one that I want to kind of draw our attention to is Southwest Airlines, one that we actually held in the roundtable portfolio and exited with a really strong relative return. Both you and I selected Southwest a few years ago, and it's popping up on all these lists, and the analysts all seem to really like it, and I thought we'd take a little bit closer look at that one. But again, nothing on here is reaching out to grab me. Perhaps that bottom one would be the one exception, and Ken covered that a few months ago, right, Ken? Copa?
I actually own Copa Holdings, Mark, in one of my portfolios, and everything that I'm able to read about it indicates that the Copa still has a great potential to make a lot of money. It's operating in a part of the world that is not having a whole lot of problems, save for Venezuela. And Venezuela is weighing real heavily on Copa right now, but Copa is doing everything it can to exit most of that Venezuelan business as quickly as it possibly can. And as it moves out of that Venezuelan business, it leaves extremely profitable business. For those of you that don't know very much about the company, it is an airline that operates in Central America and the Caribbean. It's based in Panama. It's actually an American company. But it has its hubs, its base in Panama, and it's flying to all kinds of markets that aren't being served by very many other airlines. It's especially making a lot of inroads right now into flights to many of cities in Colombia, and Panama is bordering Colombia, so it's a fairly short hop to a lot of these Colombian cities. But they're proving to be quite profitable, the routes are. But like I indicated, Venezuela is a basket case when it comes to their economy and their currency and everything else that's happening right now. And Copa had a decent presence in that country, and so it's making an attempt to move out of there. If it's successful in that, then I can see that number of 36%. I can see it as a real possibility, or at least I could visualize something in the low to mid 20s as far as par is concerned.
Yeah, it's definitely an interesting study, and you can actually go back and take a look at Ken's presentation of that a few months ago. So if I were shopping seriously, I have a hard time with airlines in the first place. I think most of us do. But if I was building a short list to scratch my head over, I think off of this list, Southwest and Copa would probably make it something I might want to dig in a little bit deeper. Here's a look at that same list and going a little bit deeper, and you've seen this analysis from us on a number of things. Where I'm basically here just making the point that we're looking at this in two dimensions. Our typical long-term dimension, again, dealing with the consensus forecast, which includes all of these people. I mean, all of these form the consensus that we use at Manifest Investing, but you see some fairly decent projected annual returns on this entire list, along with some decent quality ratings, some goods and some excellence. Again, I don't get these, so we'll just leave it at that for right now. But we see the value line, 3 to 5 year forecast. Keep in mind that that is corrected for date and change in price. So these are current value line low total return numbers. Interestingly enough, Morningstar only covers Southwest Airlines of this group, and then S&P only covers 5 of the 12, and all towards the bottom. But they are in agreement. Fair value is basically their version of a stock selection guide result. They don't calculate the projected return. They instead try to calculate a fair value, which would lead to a long-term normal return, however you want to frame that. probably like an 8 to 10% return. They basically ask the question, what price would do that? And then we compare today's current price versus that fair value price. So anything less than 100 is a company that both either Morningstar or Standard & Poor's would think is potentially on sale, and all of the entries that are shown here fit that description. Most of Wall Street uses that type of characterization, a fair value type condition. And one of the things that sets us apart is we focus on that return forecast. But again, if I were shopping, I'm favoring the bottom of that list, not so much the top. And by the way, the blanks mean that there is no data, or they're uncovered, or the data is not available for any of them that show as a blank. That 1 year analyst consensus outlook is shown here also, again, from that projected doubling in the one at the top down to the 37% at the bottom. And then we've added the 1 year outlook from the tear sheets at Standard & Poor's, and the 1 year outlook from publicly available information at Goldman Sachs, just to throw around some fairly interesting numbers. And the one that I find just fascinating, because I've been watching this for several months, is Southwest Airlines and virtually any of the airlines. And if you notice here, Value Line has a decent expectation. So it's that's decent. It's not terrible. It was worse. They were a little more pessimistic than all the other analysts. Decent consensus, but notice that both Morningstar and Standard & Poor's think it's on sale. And then interestingly enough, for the short term, Standard & Poor's is kind of gaga over the company. And then in a period when Goldman Sachs is actually usually a few percentage points more pessimistic than the rest of everybody out there, it's the only company they cover on this list, and they are really optimistic about Southwest Airlines for the coming 12 months. So that is an interesting situation, one that we're trying to follow fairly closely, and I'll give you a nutshell of it here in a second. But again, nothing's jumping off the page at me at this point. Here is the Southwest Airlines story. Again, we bought, when Hugh and I were talking about getting involved, it was back in this time frame, and we actually exited the position sometime around here, so we did quite well. But it's continued to zoom, dare I say soar, since Hugh and I exited the position. And here's the story. I don't know whether I believe this. I can't explain it yet. Some of you people who study this stuff fairly closely, I would encourage you to study and share whatever you can find. We're talking a virtual explosion in profitability at not just Southwest Airlines, but airlines across the board, at least when it comes to expectations. These are all forecasts. 2015 year end for this year, 2016, and this is the Value Line number for the 3 to 5 year forecast. Here's a company which has been among the most profitable of all airlines historically. Southwest Airlines projected to literally triple in profitability for the next 3 to 5 years, including the current year. This is what the analysts are seeing, believing, and chasing. And I don't know. I would certainly look for some downside in it. Some of the arguments have probably begun to erode a little bit. You can see that the price has trailed off. That's one of the reasons it's showing up on our screens. The price has trailed off from 47 down to 34. It is showing some fairly near-term weakness. One of the things that Hugh did share with me, he knows these airlines inside and out, as our buddy Matt Spielman does too. He did share that Southwest Airlines, in their efforts to go international, may find themselves required to abandon their process for boarding and their ticketless unassigned seating. And if they do, that'll probably be a nice convulsion for the company. Now, I don't understand exactly why they'd have to do that, but he basically says they probably would have to do that to comply with some type of global regulations or standards. So that could be an interesting thing to consider. The entire industry is going to be disrupted by a number of things, but again, I think this captures kind of an interesting thing that you can notice and monitor by watching the analyst consensus estimates. And with that, I'm going to say I don't want any of those, so none of the above. So I'm going to switch to, as I warned you in the introduction, to a screen of much higher quality. I think most stock prices are a bit vulnerable right now. I'm not I'm not sitting here talking about doomsday headed our way, but we could see some price corrections and that sort of thing. So this month, put together a list of companies with limiting the field to quality rankings greater than 95 from top to bottom that you can see there. Virtually all of these are in the sweet spot. A very large number of them are attractive from a return standpoint. Value Line in many cases is a bit more pessimistic than some of the other agencies. You can see Morningstar likes several of these. A couple of them they really don't like. They tend to struggle a little bit more with some of the cyclical companies, but you can see S&P is also kind of all over the map, but there's a number of companies that they think are justifiably on sale. And you can see some of the numbers are a little bit more subdued when it comes to the one-year outlook from the analyst consensus there. I mean, the highest number on here is 23% for Atwood Oceanics. And then you can see the numbers from S&P and Goldman Sachs also. And again, just kind of looking down that list, looking for something to warm up to, my attention is kind of drawn to that company known as Baidu. Not just because it's the highest one on the list. Ken has talked about this one in previous sessions. Chinese companies do give us the heebie-jeebies a little bit. My advice is I don't think I would consider a Chinese company unless it was relatively large. And Baidu certainly fits that description. It's not anywhere near early stage or startup. Company's been around for quite a while. It's basically the Google search engine for China. And what you see there is fairly interesting. Value Line is the only opinion that's not fairly strong. The consensus is strong. Morningstar and S&P are pretty favorable on it, as are S&P and Goldman Sachs over the nearer term. So I'm going to focus in on Baidu. Here's what it looks like in a visual analysis to take a look at the business model. We're talking about a company that's basically a $9 billion company growing in about the 20% range. And by the way, that red line regression trend through the revenue numbers is probably closer to 25 or 30%. We focused in on the last 4 or 5 years and a few years of projections to come up with the 20% number. That is in line with street estimates. The profitability, we'll take a look at this in picture form on the next slide, is in the mid-20s and fairly stable. It's matured, but it's fairly stable, and that's also fairly consistent with companies like Google. The other big major, Ken, I'm getting a little bit of typing noise. The other major judgment milestone, again, 20% growth, 25% profitability that you can see there. The third milestone is where the Value Line forecast is very differentiated from the rest of the field. They're calling for a PE ratio of 15 long term, and I think it's justifiable to look anywhere in the 20 to 30 range for a company like this. The field of opportunity is immense over there. They are keeping Google out of China for the foreseeable future. Some of my friends who actually work in that environment are very respectful of Baidu. It's a tough situation. Again, they believe that if Google is permitted to play over there and penetrate that market, that it'll probably only be in some type of a cooperative or collaborative type situation, and that would probably be good over the long term for Baidu. So again, you get the vast majority of the street, with the exception of Value Line, looking for decent returns over the long term. Fairly decent looking picture there. Again, just double checking the concept of, does a 20 to 30% or a 25% net margin make sense? I would argue that it probably does as this company matures and comes along. Same thing for the PE ratio. A lot like an airliner coming down to land on the runway. They seem to be landing in that 20-ish range. And if the company does proceed to grow and achieve that type of profitability over the longer term, it's pretty easy to justify a PE, an average PE of 20, 22, 24, something in that neighborhood. And I think Value Line's probably overreacting a little bit, and when they come in with their 15, because the company has all the metrics and seems to be executing as well as a Google or a Mercado Libre or any one of those type of companies with that type of an operating model. So we'll that'll be my stock for tonight. Baidu, the Chinese Google. I thought we'd spend just a moment tipping our derbies in the direction of Hugh. He brought Artilux to the group last month. I've encouraged him to share some of these type of ideas, and we'll just say fairly interesting study. You can go back and actually watch it from last month if you were not here, but he's up 47% in 1 month. So we appreciate that. And we hope that Ken's going to find the next one of those. Notice that nice little increase on the right-hand side there for this one. That's pretty sweet. So with that, let's go ahead and turn to Ken. I assume you're going to take the screen, Ken.
Yep, that's the wrong slide there, Mark. Let me.
Ken featured Gentex last month, and he's not doing too badly either. Since then, I think I'm the only one who stumbled last month amongst the panel. I stumbled.
Mark, are you hearing me okay?
Hearing you okay, and I can see your screen.
Great. Let me get this PowerPoint up and running. I'm going to present a stock that I've presented once or twice already. It's Polaris International. The ticker is PEE, and I'm going to start by just I'm sorry, I said PEE. It's PII. I'm going to start by just showing you where Polaris makes its sales. Notice that about 85% of its sales are in North America, 75% in this country, another 10% in Canada. Only 15% are international, and that's going to be important for you to remember as I move through this presentation because the international sales are having some issues right now with currency. But remember, this represents 15% of their business. It doesn't represent 50 or 60% of its business like it does in some of the big multinational corporations. Polaris focuses on off-road vehicles, but that red piece of the pie over there, that motorcycle piece of the pie, that is growing by leaps and bounds, and I'm going to show you some of their products as we move forward here. These slides came from their first quarter earnings announcement. They do a wonderful job in explaining what the company is doing, in comparing it to what they've already told you they're trying to do, and in taking credit where they do what they say they're going to do, and admitting right up front when they miss a number or when they miss a metric in some sort. Notice that their sales and their income were both up they both were up nicely in the quarter
respectively.
here. Okay, respectively, thank you. And they've made 2 acquisitions in the first quarter of this fiscal year. One of them is kind of exciting. It's this timber sled, and I don't know how many of you have actually seen one of these things, but it's the next evolution in snowmobiling. They call it mountain horses or mountain snow, or equivalent of some of the bikes that are being ridden up and down mountains right now. And it actually has a tire-looking tread on the back that's kind of thin. You sit on a seat, but it's not bulky like a snowmobile. Quite a big selling product, and they acquired that in the last 3 months. They also acquired a company called Hammerhead, and Hammerhead was known for some of its lower cost vehicles, appealing to younger folks, children even, in some of these go-karts for adults and for kids. That's a reasonably low price point for those kind of vehicles. And then they also have these utility vehicles, again, at fairly low price points. So it's giving them a bigger market to sell to, and it also is giving them a larger presence in the American West. Retail sales were up 8% in this last quarter compared to the industry plus signs of about 4%. You can break their business down into off-road vehicles. This is the biggest seller. More than half of what they sell are these off-road vehicles. And notice by the pictures, they're mostly four-wheelers. They don't make three-wheelers anymore. Polaris is focused on these four-wheel vehicles, whether they have roll bars or whether they have open tops. Depends on how much you're willing to spend and how big the machine happens to be, but those sales were up nicely. They also have moved aggressively into the motorcycle business. They are the sellers now of the old Indian brand motorcycle. They also sell a motorcycle branded Victory, and they have a brand new machine called a Slingshot. And a Slingshot is a kind of a motorcycle combined with a three-wheeler with the seat sitting behind the two wheels that are kind of drive wheels for the whole thing. Here's a bigger picture of what the whole thing looks like, but this vehicle has just captured the imagination of a lot of youngish men out there in the world. They're selling this thing now in 370 different locations throughout North America, and they'll be moving this brand now into the rest of the world, this machine into the rest of the world. Obviously, from its look and everything else, it goes fast, and that appeals to a certain demographic. They sell snowmobiles. It's still a reasonable part of their business. And here's this new platform that I was talking about. Doesn't look at all like a traditional snowmobile. Excuse me, and you can take it on real rough terrain. They call it a mountain sled, and it only weighs about 400 plus pounds. They have another market called the global adjacent market, and essentially that's vehicles used by the military, and then it's also vehicles used in work situations, whether it's plowing or hauling or various off-road work situations. Polaris sells a reasonable number of those vehicles. And then the last category is, excuse me, the last category is parts, garments, and accessories. And you can see that they sell about half in this category in actual accessories, and then garments, call it apparel if you want. And then they also sell quite a few parts. You can tell by the pie chart right there. Another fairly fast growing segment of their business. Their international business is what's been causing them some problems, and not from a total sales view, but the problems have been coming from the currency conversions. The decline in the value of the euro compared to the dollar especially has caused some real serious currency conversion issues, partially offset from the Mexican business, which is really growing fairly rapidly, and partially offset from some of the Asian Pacific business, which is not growing as rapidly as Polaris would like it to do. Here's my SSG, and I've estimated growth going forward at about 12%. That's extremely conservative compared to almost the entire analyst community, but I wanted to put together a very conservative SSG and then see where that led me as far as buy, sell, and hold. Looking at the numbers on the back of my SSG, I came up with an average PE of about 20, and I've moved it to a high of 24 and a low of 16. And with those judgments, I'm getting a straight 3-to-1 upside downside or a buy. Now you compare that to the Eagle, which I found on the Manifest Investing site. Remember, I estimated sales going forward at 12%. The analysts are fairly comfortable in the 15% range. I estimated PE at about 20. They're at 19, not much difference there. I have a payout ratio of about 30%, payout ratio from the analyst at 31, so not much difference there. So the only major differences between my SSG and the Eagle are what we think sales will grow at. I've chosen 12, which is at the extreme low end of the guidance issued by the company, and the analysts are more comfortable with 15. The Eagle gives a par value of 15%, 14.9 right there in green, and I get a par value of 10.6 with a total return value of 14.4. You know, I think I'm close enough, and I think that that's a pretty good return, whether the 12% comes to be or the 15% comes to be. I think between 10 and 15% for a company like this is a pretty decent return. I'll take it, and I'll suggest we add it to the portfolio for the round table. Mark, I'm going to go back to your screen.
Okay. Yeah, I'll go ahead and take care of the Gentex slide, Ken. Just as a point of interest, Gentex runs around on Polaris stuff at their facility.
Good, good.
So they're a customer. I think we can go ahead with the audience poll now.
Okay, I'm going to put the poll out there.
Sorry that we only give you 2 selections this month, but we'll still go ahead and do a poll and let the audience chime in. The audience has been doing fairly well over the last couple of years, and the guest damsels, our ladies that join us from time to time, are doing pretty well too. Kim Butcher probably would have been here tonight, but she's off with excursion with family. Susan,
we have 85% of our audience voting. I'll give you about 5 more seconds if you want to vote. You just use your mouse and click right on the screen.
do we really have to do this? This is like running unopposed. I can't see the results, but I can feel them.
Okay, well that took us to 89% voting, so I'm going to close the poll and I'm going to share the results. And 80% of the folks that voted want to add Polaris
There's no spirit of adventure out there.
to the portfolio.
Come on, China's been in the toilet.
I think, Mark, that I tainted the water with hog and Chinese stocks. Okay, it's as simple as that. Okay.
Well, fair enough. Yeah, Baidu is kind of a playful selection for sure. It was probably that or a company. Well, you know, Polaris actually came up, I think, first on my list too. We're pretty close to first.
Okay, I'm going to hide that poll now, and you should be able to go back to your screen. You are, okay.
Okay. Well, it's not even 9:40 yet, so we've got time for any questions if you want to go ahead and see.
Well,
what's
Julie just says Polaris has more fun stuff than Baidu, okay?
That's
All
true.
right. And Shirley wants to know, would buying Baidu affect our taxes in any way?
We don't pay taxes with the roundtable portfolio, but yeah, it could. They don't pay a dividend. Well, actually, no, I'm pretty sure they don't pay a dividend. With international investing, sometimes you can get into withholding situations on international stocks that generally require, you can usually recover most, if not all of it, by filing some additional paperwork, is what it kind of boils down to. That's the nutshell.
I'll tell you also that your broker probably will hit you with an ADR fee. Those are becoming pretty common.
Sure.
I hold a couple of foreign stocks in one of my portfolios, and I get charged an ADR fee by my broker. My broker happens to be Scottrade.
Mm-hmm.
So there must be some administration from their point of view, and they're passing the costs through.
Sure.
Mark, we don't have any Chi is saying that TD Ameritrade also passes a fee for an ADR.
One thing that I
Uh,
would like to do, Ken, is take advantage of the opportunity to show people where, especially if they're manifest subscribers, where they can get a quick rundown on a lot of the metrics I went through. And if you go to the Manifest Investing site, I'll keep this short and sweet. I was taking a look here at Polar or at BioReference Labs. Just go to the home page and then enter the ticker symbol PII for Polaris. Okay. That takes you to the equity analysis guide, which gives you the summary of stuff that Ken was just talking about. And this little spyglass here is a link to all columns, articles, and posts, including forum posts that include Polaris in part of the subject matter. You can see there have been a number of forum posts here. The one that I'd like to point out to the audience, if you click on the second one here, by the way, his presentation, Ken's presentation from a few months ago, so that looks like a couple years ago, the first time he presented it, they're available here also, previous presentations. But what I wanted to show the audience was this quick rundown. This is a post that talks about the presentation Ken made. You see that same type of table at the very top, but actually walks you through uh, the business model analysis, the value line numbers that we kick around, a little explanation on the price to fair value stuff, where we find it, how we calculate it. You can review that at your own leisure. There's the historical fair value numbers for Polaris. You can see they've been steadily climbing. There's the tear sheet excerpt from Standard & Poor's, and then that analyst consensus stuff you heard us talk about also, um, showing where we find that information and how we use it and how we make those calculations.
Mark, we're getting a question from William. He says that the roundtable portfolio now has about 100 different positions. You have about 50 positions with less than 1% of assets.
Mm-hmm.
Do you ever complete any housekeeping in the roundtable portfolio? And I guess I'll start the answer to that question by indicating that this isn't an investment portfolio in the strict sense of the word. It's more of a tracking portfolio, keeping track of picks that we make over a long period of time. I don't think any of us would advocate having 100 different stock
Oh no.
positions in a portfolio. But we're keeping track of picks and then trying to reach some goals with those picks. We are using a manifest dashboard to help us manage this quite lengthy portfolio, but we're not we don't often go through and drop stocks out of the portfolio that aren't performing unless their par moves down to a place where it's near zero. What would you want to add to that, Mark?
We have done that. We've trimmed out a relatively low number of positions in recent months, but I mean the process that Ken is talking about. If you basically go to a worksheet, we actually call these also call these sandboxes. Um, you can actually dive into the portfolio, and you're using a cloned or whatever they call it. Uh, you're not actually operating on the real portfolio, and literally pulling in and sorting on this last column. Remember, Ken said you could download to a spreadsheet and do this. You can also do it right here. By clicking on that par header, what I've done is brought the companies to the very top that have the weakest return forecasts. Now, I happen to know that as soon as we run the next update for U.S. physical therapy, thanks to some fundamental upgrades, some increases in analyst expectations, that number is going to be closer to 7%. And that's one that Ken is very close to. But if we were to begin challenging companies, companies like Coca-Cola and Hawkins would probably hit that list, perhaps even McDonald's. We could trim a few out and impact the overall portfolio a little bit, but it's something we don't pursue actively, and the reason is because we don't need to. The portfolio itself is coming in right around 11% right now, pretty close to the market average plus 5%. So there's really no need to, and especially with the companies that have the higher quality rankings, we typically, we're trying to emulate real life a little bit here, in that a company like Coca-Cola, we're not going to rush to sell. It has an extremely high, excellent quality rating. The only time we would really want to dump that would be if it went probably zero or sub-zero with respect to the return forecast. And that does happen. It's been a while. People forget that, back 14, 15 years ago, there were a number of fairly highly thought of stocks that actually had negative return forecasts, and people would have been well advised to consider trimming some of those positions. So we do look at it from time to time, and we probably will put some of these towards the bottom of the list, top in this case, as I've got it sorted.
Yeah, it is interesting to note, Mark, that the growth for these stocks near the bottom of the par list is also fairly low, with a few notable exceptions. And frankly, you tend to expect that's going to happen, that when the par is fairly low, a lot of times the growth is low to match that low par. But if we ever got serious about boosting growth, our candidates for boosting growth probably would be from these companies that you're looking at right here.
Well, I mean, look at Roche Holdings. That's one that I picked, I believe, in the second session back in August 2010. It's more than doubled. It's actually performed pretty well, but Roche is not an exciting growth company. It's an extremely good international pharmaceutical company, but it's had a pretty decent run, and that decent run has driven the return forecast down into low single digits. So I'm certainly not completely emotionally attached to Roche, so that could be one that gets jettisoned. Hawkins has been kind of a moderate performer. I picked that one also a couple of times. So we could perhaps trim a few of these out. And I agree completely with Ken. 100, we would never do this with 100. If you want to watch how we would do this with a typical traditional portfolio, watch what we do with 10 Cup, which is kept kind of in that 16 stock plus or minus range for that as a model portfolio.
Mark, Susan would like to know, will BRLI stay on this list now that we've sold the position?
It'll disappear from the tracking portfolio, but the contribution will always be there in the internal rate of return calculation. The decisions will be basically locked in, and obviously the results are always going to be in that rate of return calculation.
Okay, but it will leave the tracking portfolio because it's not actively held anymore, okay? Yeah. Julie wants to know, she has a question for me. She says, on the Polaris SSG, does it give me concern that the current PE is relatively high compared to the average PE? In this case, Julie, no, it doesn't, because I'm noticing definite uptrends in both the high and the low PE values. So I'm not especially concerned that the current is higher than the average. This is pointing out one of the issues that I have with the concept of relative value. Relative value is a great metric to use if you're staying within a certain range in PE values and they're staying relatively constant. But when PEs are expanding or contracting, relative value many times gives you what I like to call false readings. I'm not concerned because of the fact that these PEs on Polaris are increasing for the last 5 years. And frankly, what that tells me is the market is discovering this stock and giving it a higher valuation because of its performance. William says, just think what you can accomplish by trimming the low quality positions. William, we'd have to run right through Hugh McManus if we wanted to trim all the low quality stocks, because those are exactly the stocks many times that that Hugh likes to invest in. Remember his philosophy of looking for great stocks that have been terribly beaten down and that are selling at a very low price compared to the last year or sometimes the last 3 or 4 years. And I look at some of the lower quality stocks on this list right here, and I say to myself as I read the lower quality stocks, Hugh, 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 Hugh. So
Well, there's a Kim Butcher in there too.
there's a number of other, there's some of us have joined in there, and some of us have looked at some of our high quality stocks, moved down to low quality stocks. I notice Vera is down to a 52 quality now, Vera Bradley, but I know when it was chosen, it was sitting at a much higher quality rating.
Yikes.
And there you can see what's been happening to this maker of women's accessories.
I had no
It's just
idea.
been deteriorating. Oh, I did. Yeah. So some of these at low quality were originally high quality, and maybe that's the metric we should use. We should kind of compare what was its quality when we chose it to what's its quality now, and maybe that's also a good way to jettison a few of the stocks from the portfolio.
Well, you've hit on a good topic there. I mean, I'd certainly not average or double down into Vera Bradley under these conditions. But one of the capabilities that we're going to be demonstrating and spending a lot more time with is this notion of alerts and flagging a deteriorating quality situation, and this one would have fit the bill of at least scratching our head over a declining quality situation. Keep in mind that means that whatever's happening at Vera Bradley, they're either in comparison to other similar companies, they're growing slower, achieving lower profitability. Perhaps their financial strength has even taken a hit, and their earnings have become more erratic. Those things are happening, and it's not imagination. And it doesn't look like they're getting any better, Ken.
You're right. I exited my holdings in Vera about maybe 2 years ago, so I haven't looked back. And that doesn't mean that my wife still doesn't love the product. My wife and my granddaughters, all three of them, are in love with the Vera Bradley product.
Oh yeah.
And I know your wife and daughter used to be. Are they still enamored with the product, Mark?
Yeah, they both are. They're groupies. They've been to the Mecca. They've been there. They've actually elbowed and thrown people to the floor and been involved in that down in Fort Wayne, Indiana.
Well, Mark, we've cleared all the questions from the question log, and usually when I say that, 3 or 4 more appear. I don't see any hands in the air, and we've been with our friends now for about an hour and 25 minutes.
That's probably enough for a summer evening.
I think so. Again, my thanks go to you and to all you folks in the audience that come in and listen to us once a month. Our next roundtable in July, for those of you that like to keep a calendar, will be on July 28th. So you can mark that on your calendar. And I don't see any more questions appearing, so good night, Mark, and good night, everybody. Thanks for coming.
Talk to you soon. Thanks, everybody. Good night.